What's going on, DeRosa Insiders community? It's Matt Faircloth, and welcome to DeRosa Insiders Live. That's right, live. This program is live recorded here on the DeRosa Group YouTube page. This program is live recorded and broadcast here on the DeRosa Group Facebook page. And this program is live recorded on the DeRosa Group LinkedIn page. So wherever you're watching, thank you. And if you're watching the recording of this program, that's all good. Thank you as well. Appreciate you guys doing any of those things that you are to enjoying this program. And I got a big fat thank you if you want to go over to DeRosa Group's private but free Facebook community called DeRosa Insiders on Facebook. So go to your magic internet box, maybe your cell phone, maybe your computer, and go to Facebook. You might have heard of that website, facebook.com, and go to DeRosa Insiders on Facebook and join that community. It's free. Why not? There's all kinds of folks talking real estate shop out there. Thousands of members of DeRosa Insiders now. So go join DeRosa Insiders on Facebook, and we hope to see you guys there. Guys, today we have a great show for you. It's a very special show because I got a very special guest, and we're going to be talking about markets to invest in, markets to ignore, and where, if you are building your thriving real estate business, maybe I'll get our guest to give you some hot tips on where, markets he likes, markets he doesn't like. So if you guys follow DeRosa at all, you probably are going to guess that my very special guest for today is my brother from another mother, our market hunter, my business partner. A lot of things to DeRosa, the third leg of the DeRosa tricycle, and that is my partner, my man, Hervé Francois. How are you today, buddy?
Hey, Matt, how's it going, man? Always great to be here. Great to see you. Third leg, huh? Third leg? Okay, thought it was second, but
you can be the second. That's fine. Just gonna be the third leg. Yeah. The third wheel in the tricycle. But you see, a tricycle is nothing without three wheels. A bar stool does not stand without three legs. These things collapse. There is a magic number in three. And so I'm really grateful in having you here, Hervé, as our to talk to us about markets, man. So how you been?
I've been doing great. And man, if I could take the time to go ahead and give you a shout out to you and your lovely wife. Happy anniversary to the Faircloths. Well deserved. Hey, listen, man, I don't know how Liz has done it all these years. I tell you right now.
I don't either.
My hat off to her. But no, listen, man, congratulations. You guys are the pinnacle of how couples are really spending time with each other, quality time with each other, raising two beautiful kids, and you guys are quasi still working with each other, which is really amazing. And you know what I mean? So that's very impressive. Congratulations.
We serve as each other's board of directors in a lot of ways, right? Because she has her own thriving community. I mean, Liz is building wealth for women through the real estate investor community. Very, very justified, very worthy cause that she's doing over there. And I'm like a board of directors, like a helper, so to speak, for investor, just as she is for my ventures at DeRosa. Her and I were very active together, but we also both wanted to build our own thing. And it's not that we didn't want to work together. We just wanted to build something that we were super core passionate about. Right. And so her and I decided to be attached at the hip, linked at the arms, but also building in similar directions, but also in our own little lanes. Right. So, and in a lot of ways, it's what works well for us. And it may work well for other couples that are out there investing with your spouse, such as Tara Hoycholino as well, one of our students. Right. Hey, Tara, didn't know I was going to pick on you, did you? But Tara, investing with your spouse as well. That's what we're talking about, because Liz and I celebrate 19 years of marriage today. And that. So thanks for watching.
Congratulations.
Yeah. Thank you, sir. Thank you, sir.
Yes.
All right. So Hervé, markets. It is, you can't just cast a fish hook into any market of the United States and expect to catch deals. People don't realize that I would say at least half of real estate investing success is choosing the market that's going to serve your goals, that's going to have the things that you need to achieve real growth. I don't think you can invest anywhere. I'm not a believer that one investment strategy works in every market in the United States. What do you think about that?
Yeah, no, I agree 100%, man. You know, it's you want to, as you start this business, you're climbing this hill, trying to get to, if you want to call like a plateau mountain, the top of the mountain, to get to a level of comfort, to get to a level of maybe not necessarily ease, but certainly a cadence in which you understand the dynamics of a particular market. You understand the players and you get to know the players in that particular market. When I mean players, I'm talking about commercial brokers, I'm talking about attorneys, I'm talking about property managers, I'm talking about construction folks and everything else like that, right? That you have these folks when they talk about, the outside team that you need in order to get a real estate deal done. These are folks that you need to get your deals done, right? And so you want to be able to go to a market. You don't need to go to 2 or 3 or 10. You need to go to one market, plant your flag, and get to know that market's universe, right? And everything that is needed in order to go ahead and complete your real estate deal in that particular market. Again, the brokers, the lawyers, and PMs, and so on and so forth, right? And then from there, you're making a name for yourself. People are getting to know you. Other brokers are wanting to reach out to you because they see that you're buying in that market. Sellers may be reaching out to you because they see that you're buying in that market, and so on and so forth. So we love real estate, but we also know that real estate doesn't come without its challenges, right? And so is there anything that we can do as we are pursuing our journey, or as we are on our journey and pursuing our goals, to make this job, to make this cadence a little bit easier, so we're not always pedaling our bicycle uphill, if you will, right? And I think one of the things you can do to make your process easier, to make your journey easier, so you don't feel like you're pedaling uphill, is to don't go into a market where the competition is so incredibly intense, right? As you very well know, Matt, because you've been doing this for, 18, 19 years right now, the idea of syndicated deals and individual investors, private investors, doing these large deals and getting investors into deals really started in earnest 10, 12 years ago. Many, 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 many years ago, there wasn't a bunch of private investors doing syndicated deals. It was pretty much left in the hands of institutional investors, private equity investors, family offices, and so on and so forth, right? But lenders opened up their checkbooks. They started lending out, right? We started seeing these conferences sprout up. As bigger pockets grew, more investors, individual investors started getting into the business, best ever conferences, and so on and so forth. So now you're seeing competition going into these markets, wanting to do deals, understandably,
Yep.
right? Because we talk about the benefits and the tax advantages and so on and so forth. But a lot of these investors are going into these bigger cities, the big cities that we know. And if you talk about the window, Atlanta and Charlotte and Dallas and Houston and Austin and Phoenix and Tampa and so on and so forth.
Where all the cool kids are going, right, Hervé?
Cool kids are going, right? But guess what, man? There's some cool kids in some of these smaller cities, right? But not as many, but great opportunities. And that's where, as you know, we've decided for DeRosa to make a living for ourselves. And that's what we kind of push to educate our students. Hey, think about investing in these secondary, even tertiary markets, just to go ahead. And so you will face less competition. And again, you're into an easier cadence and not having as much difficulty pedaling that bike uphill.
Mm-hmm. Yeah. I was just on the Bigger Pockets podcast. We just recorded this morning with Dave Meyer, new host. He's got an Instagram feed called the Data Deli.
Okay.
And we talked. What's that?
Yes. I've read a lot of Dave Meyer stuff. Very thorough.
Yeah. No, he's a smart dude. And we talked a lot about what you and I just referred to, about the cool kids, right?
Yep.
About investing in markets where the cool kids are going and staying away from markets. And now, like, we talked about Austin, Texas, right? And that, and like, great market. Austin's not going to crash and become like a zero market or whatever it is, but it is over. Is it over invested because all the attention that it got? Absolutely. Is it overbuilt? well, rents are down 8% this year in Austin, Texas, right? That's an example of an oversupply. That's what's going to happen. It's not because people can afford to live there anymore. It's because there's too many apartment buildings and rentals in that market that are competing for the same dollar, right? Austin will be fine. I do not shed a tear for those that are investing in Austin. I think they'll be just fine.
It's going to be just fine.
Yeah.
Going to be just fine.
You got to absorb all that, though.
You have to absorb it, right? And they needed to bring on all that supply because there was there was an imbalance on supply demand of units for the past 2 to 3 years, right? I mean, the pandemic came along, then we had very expensive raw materials, lumber prices, really that kind of just put new construction on the sidelines and things like that, right? Those issues, they've been dealt with, they've been alleviated, more supply hitting the market in a lot of those large cities, right? Austin being one of them. Austin is ranked 3rd in the country that is receiving this, huge supply of incoming units into the market here in 2024. That being said, those big cities that I just mentioned, including Austin, they're going to be okay. They're going to
say it again. So are you saying 1/3 of the new deliveries of multifamily, 1/3 is in Austin?
Yeah, absolutely. Absolutely. It's Brooklyn, New York is number 1, Dallas, Texas is number 2, and Austin is a little lower at number 3.
Huh.
Yeah.
Brooklyn, New York.
Oh. Brooklyn, New York, man.
You don't hear about that. Yeah.
We supply, but an example of another city, a borough of New York, right? One of the 5 boroughs of New York, in which, again, living expenses in Manhattan, absolutely astronomical, right? And this is one of the boroughs right across the bridges, Manhattan Bridge and Brooklyn Bridge, that people can move into, yet at the same time, they can easily get into Manhattan for work, for school, just by taking the subway, right? And go ahead and you cut your property prices down.
Yeah, absolutely. So Hervé, there's an article that you and I that you wanted to highlight for us here that maybe we can unpack, and maybe our man Nabiku can post it out here. But we got here 10 benefits of investing in secondary and tertiary markets, which is what we do. And I'm not saying that we're not going to talk today about why you should not invest in Austin. If you want to do that, great. You live in Austin, or you got contacts there, or if you just believe that's where it's going to go. As Hervé said, it's going to be fine. That market's not going to crash. But we believe at DeRosa there is a strong philosophy we have with our accelerator students that we talk about, which is that there is money to be made in these not major metros, but in the secondary cities that are just next door. So talk to me, Hervé, about this article you got, and we can start to unpack it.
Yeah, so this article is real interesting, right? I mean, it's a lot. It just kind of goes over a lot of the reasons why we decide to go ahead and invest in secondary markets. And this is the 10 benefits of investing in secondary and what they also call tertiary markets and things like that. And so I read it and I was like, you know what, this is kind of interesting. They summarize it very, very well. They hit a lot of the points that we know about. They did bring up some other interesting points. Like, that's also an interesting point that we can absorb and put our arms around as well. So I think they make a strong case for it, and they're able to make a strong case for investing in secondary and tertiary markets without, like you said, without having to knock down the benefits and attractiveness of investing in the larger primary metro markets and things like that. So again, just like you said, if Austin is where you want to invest, if Dallas, Phoenix is where you want to invest, absolutely have at it. All our point is that it doesn't need to be as difficult. It doesn't need to be as challenging for you to find opportunities in those primary markets when you can find just as much, if not more, with attractive returns, opportunities in secondary and tertiary markets. Mm-hmm. And then there's a whole bunch of other reasons of why to invest in these secondary and tertiary markets.
Yeah. Well, would you want to jump into those reasons? Where do you want to go, man? I'll let you drive here. Take me where you want to go with this article, or how you want to start unpacking some of the things.
I'll
really good stuff here.
Break it down. I'll keep it simple, and then we'll do at the very end what was not included in this article, but what I did a little extra homework. Homework. Right? I went ahead and I chose 2 cities, a primary market and the secondary market, just to do like a tail of the tape, vis-a-vis kind of a thing, right?
Let's do it.
And not to pitch one market versus another, but to see where there are some similarities, where there are some differences, and again, just kind of bolstering the benefits of investing in a secondary market. So number one is affordability, right? And you think about, okay, we have X amount of dollars to invest. I can raise X amount of dollars from equity investors, as well as getting capital from lenders and everything else like that. You're going to be able to, let's say, expand your real estate portfolio investing in secondary markets versus primary markets, because the properties in secondary markets, for the most part, are coming in at a lower purchase price. Right, they're going to be coming in at a lower purchase price. So, I'm not going to say necessarily 2-for-1 secondary market versus primary market, but you're going to be able to scale your portfolio quicker by choosing to invest in a secondary or tertiary market versus primary market. You're starting off and you want to invest in one of those primary markets. Okay, no problem with it, but you're going to probably be, lifting your sofa couches for the last few pennies that you have in your house, because they're coming in at a pretty significant premium because they are in those primary major cities. So affordability is a big reason, big benefit of investing in the secondary or tertiary market. A second is like I was mentioning before, folks, is just the lower competition, right? Just typically less competition in the secondary markets versus the primary markets. There are just fewer buyers in secondary markets. In the primary markets, guys, you're going to find what I was saying earlier, the big institutional buyers like the BlackRocks of the world and whatnot. You're going to find private equity funds getting into it like a Cerebus, and then you're going to find family offices, right? They don't as much trek into the secondary markets, a little bit, but nowhere near as much, because those folks, they need scale. They need to take a big chunk out of a primary market in order to affect its needles.
Let me unpack that a little bit too, by the way. So for you guys listening, recording live or whatever, here's why you don't want to go up against BlackRock, right? A BlackRock or a family office, whatever it is, right? Yeah, they got more money than you do. I got that, right? And yeah, they can raise more money from their investors. Yes, but that doesn't. What that means is they can maybe take down larger deals. The reason why BlackRock and family offices have an unfair advantage over you is that for all the reasons and through different mechanisms, and by them blending their investment returns and things like that, they can tolerate a lower return than you can, right? And so they can do a deal and they could be just fine as long as they're beating inflation. If they're north of like 4% in cash on cash, they're going to be happy because they might have something that's slaying it over here they can blend it out with. What they're looking to do is, like, their primary incentive when they invest in markets is to put money to work, right? They've got money that's coming in from their investor base and from all their different outlets, and they're, be that, pension funds or, large dollars we're trying to put to work, insurance companies, all that stuff. They're really just trying to put money to work and trying to stay ahead of inflation, where for you might be syndicating, as we teach our students to do. And you're certainly trying to stay way ahead of inflation. You might want to be like double or triple inflation rates with your cash on cash returns or with your IRR on deals. And so they can simply pay more than you can on properties. They're not going to be shopping in secondaries and tertiaries. They're going to want to buy in core markets that have a high propensity to preserve capital, a high propensity that over a long game, and they can wait longer than you can too, by the way, over a long game, that they're going to see upside potential. Hervé, how did I do with my?
You did very well. Yeah, you nailed it, man. You absolutely did. Those are exactly the reasons. And listen, Matt, in our day-to-day, that's what we've seen, right? The institutional buyers going into, as you know, we heavily invest in the Carolinas. So we get a lot of deals that come across our desk in the areas that we like to invest in the Carolinas, but also in the larger cities like a Charlotte, right? And then typically when I see these 400 unit, 885 units kind of things, right? We know these are the kind of properties that the institutional buyers are going into, right? Particularly in a larger city like Charlotte versus some of the secondary cities that we've seen in Piedmont Triad area. A third reason or at least a benefit for investing in secondary and tertiary market, and I like this one a lot because they spell it out well, is targeting properties in secondary and tertiary markets gives you now have access to a greater pool of lenders to choose from when it's time for you to go ahead and find the lender, the loan that you're going to put on this property. Think about it this way, right? And Matt can attest to this because we recently closed a small deal in North Carolina, right? But when we were looking for a lender for that deal, we were able to speak to the local community bank. We were able to speak to life insurance companies. We were able to speak to lenders of Freddie and Fannie as well, but those would have been low balance loans, if you will, from those Freddie or Fannie lenders, right? But I mean, that's just 4 type of lenders right there. Probably you could have thrown, savings and loans banks as well. That's 4 to 5 different type of lenders that you can cherry pick from to get the loan to put on your property that you would not be able to have that level of access if you're buying the bigger, more expensive properties in the primary markets.
Mm-hmm.
So just you have easier access to capital. Again, obviously, this is very much when you're starting off building your portfolio. You have much more choices on access to capital when you're starting off with these smaller deals in these secondary and tertiary cities, right? And then at the same time, obviously, your equity check for your overall capital stack does not need to be as big, right? Because you're starting off small. It doesn't need to be as big going after these properties in these secondary and tertiary cities as well, right? And this is what I was talking about earlier about going into a market, developing relationships with brokers and lawyers. You want to develop relationships with those local lenders as well, particularly if your portfolio is going to be consisting of 20, 30, 40, 50, 60 units, right? Those are the type of properties local lenders love to go ahead into, right? So another great benefit of investing in secondary and tertiary markets. Another one, number 4, I would say, is increased returns, right? This kind of speaks for itself. Matt, you alluded this a little bit as well, right? You have the higher investment cap rates in the secondary markets, right? That's just going to give you the ability to put out a higher ROI, for your investors, a higher internal rate of return, for your investors. And that's really because, again, we're talking about the lower purchase price of properties in those secondary markets as well. Number 5 is lower volatility, right? Secondary markets, tertiary markets, they tend to have lower volatility during economic slowdowns and economic downturns and things like that. Think about if you are invested in a primary city, right, that has a couple of really large auto factories, right? For example, you have the BMW in cities down in South Carolina and things like that. If those companies completely pull that factory, they just shut that factory down, they move out, they're taking the headquarters or going to another city, that's a big hit to that primary city. That is a really, really, really big hit. A lot of folks are living in that primary city, so it's easy for them to get to work and things like that. The secondary cities, folks, they don't take as much of a blow as the primary cities do. You're going to see vacancy really start to increase quicker at those properties in the primary cities versus in the secondary cities, right? And so it's not going to be as volatile, those economic swings for properties in secondary and tertiary markets as it is in primary markets.
It's so funny, Hervé, just to comment on that, because I've been around for a while and we've seen investing happen. And I've seen cities, Hervé, spike and crash twice in my investing career. I'll give you a few examples. Las Vegas, Miami, and Miami separately are markets that went like this during the condo bubble boom of 2005, 6, 7, and then smashed out, fell apart, and then are now spiking up again, right? In that. So are they going to crash again? I don't know. But these are markets that got heavily built during big upticks and stuff like that in the real estate market. Secondary and tertiaries don't spike and crash like that. Hey man, if you want to step up to the real estate roulette table, then get in one of those primary markets and hopefully you catch it during a spike. But odds are the market's certainly going to correct or at least get stagnant for a while incomes have to catch up with the growth in property value that's happened in that market. Absolutely. Where you're I think, better off investing in a tertiary right down the street or a secondary right down, a couple towns over, that might not see the spikes, but isn't going to see the crash either. And it's going to be just way more linear growth, which is predictable, I think, over time.
Yeah, absolutely. And, if you think about like this, we talk about like the top 10 cities that have absorbed about 600,000 new units hitting the United States this year. They're all your primary cities. They're all those cities are all in primary markets. They're all in the major metros, right? You're not seeing it. And that's why those major metros are all facing rent declines this year because of all this incoming supply. So you're talking about Austin earlier. This is a city in 2024 that has seen rent declines of anywhere between 8 to 12%.
Yeah.
You're not hearing about those kind of rent declines in the secondary markets, right? And so that's very telling. The secondary markets, they don't get hit with that huge supply of units like primary markets do.
Yeah, a lot of secondary markets that we've invested in, you can't afford to put cranes up. Like there's not, it's a market that it doesn't make economic sense to build new. And that's interesting to look at. A lot of your big primary markets, if new construction makes fiscal sense, look out, because there'll be if the market's really popping, there'll be new construction all over the place before you know it.
Absolutely. Yeah, absolutely. Sixth benefit, appreciation potential. Most likely you're purchasing that property in the secondary, tertiary market, again, at a lower purchase price. If you have an investment strategy of a long-term hold of that property, most likely you're going to see a much higher appreciation potential in there, right? You typically don't hear about that in secondary markets. We hear about cash flow, really depending on what region of the country that you're investing in, particularly if you're investing Southwest, it's all about cash flow. Up here Northeast, it's all about appreciation. But guess what, folks? Even in those secondary markets, you've seen some nice appreciation because of the price points that you get in. Also, you're just not seeing as much bidding going on properties in secondary and tertiary markets as you do in first markets, right? So a lot of times you're going after a property in a primary market. And again, think about the buyers that are in there, the institutional and private equity and family offices, right? They're buying these things many times at an inflated price, right? You've gotten so many buyers involved. Then we didn't even talk about international money coming in. The overseas money.
International money's not going to secondary, tertiary markets.
No, they're big, and they're coming in and they use money from the Gulf, money from China.
International money buys Rockefeller Center, not, they're not out in the middle of nowhere.
Exactly. Right. And so, those prices, right? So that's another great benefit of investing in the secondary, tertiary, more opportunities for appreciation potential. Seventh benefit, the value-added prospects. You typically find we were talking about new supply of all these units coming into these primary markets, right? You typically have a little bit of an older stock of properties in secondary and tertiary markets, which positions those properties when you acquire them to be very attractive from a value add perspective, right? In regards to things that you can do to that property, moves that you can make to that property on the interior and the exterior to go ahead and reposition perhaps that Class C to a Class B or that Class B to B plus, Class A kind of a thing, right? Because again, it's a little bit of an older stock. They're not getting hit with as much supply. They are coming supply. There is new supply coming into the secondary markets, but nowhere near to the wave that's coming into the primary markets. So there's just a bigger sample size, if you will, of value add deals to be acquired in secondary and tertiary markets versus primary markets. And if repositioning is a big part of your business plan, holding on to it, being able to generate that cash flow to pay investors back, some on their distributions, you want those value add deals, better opportunities for value add deals in secondary and tertiary markets versus primary markets.
Absolutely. Keep going.
Yeah, man. So that's number 7 on the 7th benefit. I would say that the 8th, rounding out the last 3 here, organic rent growth. The rent growth in secondary markets, they typically follow the rent growth patterns in primary markets, but a little bit of a slower growth rate. And to me, that is okay, right? You don't necessarily need to be investing in a market that's showing rent growth of 7, 8, 9, 10% on an annualized basis. Because again, those are the ones that are going to get hit with a lot of volatile swings one way or another, depending on how the economy is going. Steady Eddie wins the race in real estate. even more so if the strategy is for long-term hold, right? That's why we love those markets where you see some rent growth of 2%, 3%, kind of a thing, right? Those are more manageable. We can go ahead and slowly raise rents on our residents every year, and it's not going to take a big bite out of their pocket, and so on and so forth, versus in the primary markets, having to try to take those rents up significantly each year. After a while, it does start to hurt your pockets, but you're forced to do it because your expenses are going up so much higher on the properties that you own in those primary markets as well. So we really like the lower rent growth, not declining, but on just a comparative basis, on a relative basis, a little bit of a lower rent growth on properties in secondary and tertiary markets versus the primary markets. The ninth benefit, early entry advantage, getting into a secondary or tertiary market early on, just as that market is kind of hitting its cusp on its economic upturn, perhaps because a new hospital's coming in, they're adding a new wing, a college is being built or it's expanding, companies are adding new factories and so on and so forth. To get it early on, you don't need a bottom ticket. You don't need to be the absolute first person in that particular property. But we all know there's if you will, telltale signs that a market is beginning to improve, beginning to turn up. At the most minimal level, the population growth of that particular city. But then there are other signs that we can see. So if you can get in early or not, again, you start talking about adding to your portfolio. There's so much more that you can add to your portfolio getting in early in the secondary market as it begins its economic upswing. And the last, number 10 benefit, last but not least, because there's so many more, but we're just going to end here, is just kind of, broaden market perspectives, right? We talked about it earlier, how secondary markets are often shielded from risk associated with the primary markets, right? In regards to if a factory shuts down, if a hospital shuts down, God forbid, things like that. And so the secondary markets, they just react more effectively to those market shifts versus the primary markets. You don't see the volatility in it, right? So again, folks, steady Eddie wins the race, the opportunity to go ahead and get in earlier. And I would say really the number one and number two, my top two reasons is on secondary and tertiary markets versus primary markets, not as much competition of buyers of properties. And number two, a wider array of access to capital to purchase properties in secondary and tertiary markets.
Very, very good stuff, Hervé. I couldn't agree with more, and you're really backing up a lot of, what our philosophy is and where to invest. Guys, make sure you check out the article. But Hervé, you actually were going to put the proof in the pudding, and you're going to show us a couple markets that you've done research on to do some comparisons here. Show us what you put together for us, and if you wanted to screen share whatever you got here, happy to go through that with you.
Yeah, let me see what I can do here in going ahead and screen sharing with you. Let's see here. All right. So I would present and all right. Let me know. Can you see this page here, Matt?
I got to bring it in.
Okay.
There you go. All right, go ahead.
All right, primary market.
Tail of the tape, Hervé. Go ahead.
Tail of the tape, right? So we got San Antonio, Texas in the right corner. We got New Braunfels, Texas in the left corner, right? So just a comparison of these two cities, which New Braunfels is literally 40 minutes northeast of San Antonio. It's actually nicely placed between San Antonio on the west and Austin, Texas on the east, right? And you see the breakdown here, right? A typical primary versus a typical secondary market. Again, not knocking San Antonio. I hear beautiful things, never been. I hear beautiful things, have great economy, and so on and so forth. But population 1.5 million in San Antonio versus the population in New Braunfels, just about 117,000. But look at the population growth rate over the past 4 years and over the next 5 years for both cities, right? Just a little more than 5% population growth, which is really solid for San Antonio over the last 4 years. But look at that population growth in New Braunfels, 28%, and expecting another 27% looking out through 2029, right? Whereas San Antonio, 5.6%. Now you can say, hey, listen, all right, this is all right, the law of big numbers and everything else. Sure, the law of big numbers, but 28% growth over the past 4 years, 27% growth over the next 5 years is pretty incredible. Very, very healthy. So I know when I'm looking at properties in New Braunfels, I don't have to worry about finding residents for my properties, right? Yeah, I've got people moving in from all over the place. I wouldn't be surprised if a lot of people moving into New Braunfels is coming from both San Antonio as well as Austin, Texas, right? And why? Biggest reason is because cost of living is cheaper in New Braunfels versus San Antonio and Austin. Job growth in San Antonio, 2%, still solid, 2%. New Braunfels, 6%. So it's not like there's a bunch of retirees moving to New Braunfels or folks that's just going to come and take advantage of what I keep on hearing, the beautiful outdoors in New Braunfels. But they're coming and they're putting in the work. Before we talk about the average cap rate, because there's a reasoning there, but let's go into the asking rent. You see the difference in the asking rents, right? Almost $1,900 a month in New Braunfels, closer to $1,500 a month. Excuse me, $1,900 in San Antonio, $1,500 a month in New Braunfels. Now, you would think that because of San Antonio, higher purchase prices and everything else like that, that they would have a lower cap rate. Well, the reason why is, and again, we were talking about this at the top of the hour, all this supply of new units coming into these bigger cities, like a San Antonio, like an Austin, like a Dallas, like a Tampa. And so what that's done, not only has that put downward pressure on rents in those cities, Matt, it's also put downward pressure on the property prices in those cities. And so that's why the average cap rate in those cities are right now trending higher versus the cap rates in the secondary cities. What do I expect going into 2025? I expect that to flip, right? Because I expect transactions going to start picking up as we go into the slow interest rate environment. Transactions pick up, property prices start to go ahead and pick up as we go again into the slower interest rate environment. And with that, we're going to see the average cap rate for properties in primary markets start to go down. Does that make sense?
Yep. Yeah, no, I get it. So you're saying that new construction in San Antonio, and just in the overdevelopment and this is like, this is what happens in big cities. They do this.
That's right.
They do that.
That's right. Exactly.
So
that's right.
You're saying that cap rate bump right now in San Antonio is a sign of the roller coaster ups and down bumps in that. But it looks like population and not like the numbers are actually favoring New Braunfels with regards to population increases, job growth. That stuff is actually pointing the right way in New Braunfels longer term. So likely you have a better chance of rents bumping well above 1522. Yeah. Okay. All right.
So that ramp, I love that ramp that we see in New Braunfels, right? I'm getting into a city kind of early here that's on its own upswing, right? And it's nicely, equidistant, if you will, between San Antonio and Austin.
Got it. Okay.
So yeah, nicely sandwiched and a lot to benefit from.
Very good. Okay. Yeah, very good. Let's take that. Can I take that down?
Yeah, absolutely.
Good. Cool. So Hervé, I think that listen, there's people out there who say, no, you know what, I'm going to invest in Charlotte, and keep doing that. Again, your investment equation, guys, has to match with your goals. But what's worked for us with our target of good long-term appreciation, long-term IRR growth, and good cash flow early into the game, it works in secondary and tertiary markets. So, Hervé, that you've developed some tools for people to consider, like people like, okay, I kind of want to drink from that DeRosa philosophy, so to speak, drink the DeRosa Kool-Aid, and maybe not invest in the top tier markets, maybe invest in the market 2 towns over from the top tier market, so to speak. Exactly. That's going to be enjoying the bump that top tier market has provided without paying the price that top tier market costs, right?
Great way to put it.
Tell us a bit about it, and I'll screen share this myself here. But tell us a bit about this market hunter compass that you've assembled for our audience here as a gift, free gift, guys, that Hervé came up with to give you guys today. So Hervé, tell us a little bit about, as I get into sharing this thing, tell us a little bit about what you've got in store for him here.
Yeah, no, I'm more than happy to. Listen, Matt, you know what? This list here was really spurned, by me getting a lot of questions from investors, from students all the time. Hey, Hervé, where do you think I should invest? What markets are you liking right now? What's kind of hot, what's growing, and so on and so forth, right? And there's so many ways to go ahead and answer that question, depending on where the person is living, depending on what their business strategy is, and things like that, and appreciation, cash flow, and so on and so forth, number of units that they want to buy. So what I decided to do was, again, knowing that, as you know, we like to favor the secondary markets and tertiary markets, that I went ahead and made a list of a lot of the major metros across the country. But then from there, I opened it up and I listed about 4 to 5 cities under each of those major metros that could be an attractive place to invest. Now, I'm not going ahead and validating that every secondary and tertiary city on this list is a great place to invest. But if you happen to be living in one of those major metros, and I've gotten in so many, Hervé, I live in Dallas, and everything is so expensive over here, and this is a big buck coming down here and everything else like that. I'm like, okay. So what I did is that I'll show you Dallas, and then I'll show you some of those secondary and tertiary cities around the loop of Dallas, right? Perhaps 30, 40 minutes away, kind of a thing, where the population size, so I put the name of the city as well as the population of that size next to that city's name, all under that major metro. And again, I did it for a lot of the major metros. I did it by region, southern region, northern region, east, west, and everything else like that. So now you could take a look at some of these cities like, hey, listen, I don't need to invest in Dallas. I don't need to invest in Tampa. I don't need to invest in Phoenix, right? I can invest in Murfreesboro, Tennessee versus investing in Nashville, Tennessee.
Yeah.
Kind of a thing, right? And same thing, Fells, Texas versus San Antonio, Texas, and things like that. So these are, I think it's a real handy dandy list. I'd argue certainly continue to do your homework once you get your hands on this list. And oh, by the way, I'll throw in another plug. You can do your homework and start to do your homework if you go ahead and download our free market analysis tool, which shows you the list of resources around the web where you can start doing your research, you can start doing your digging of all the aspects of the secondary and tertiary cities. Where do you find the population and the population growth of a particular city, as well as job growth, the industries that make up the particular economy that drive it? Where do I find this information? So I'd recommend don't only use one of those tools, use both of those tools in conjunction with each other to first identify that secondary city that you like to invest. And then the second tool, using the resources to really identify if that secondary city is an attractive place to invest.
So to say it back, guys, what everybody's done is he's picked some of the top cities in the U.S., be that Phoenix, San Diego, Atlanta, whatever you got, right? Nashville. Those are cool kid cities. But cool, as y'all know from going in high school, man, the cool kids aren't the ones that get the good paying jobs, right? The cool kid's the one that ends up pumping your gas, okay? You need to go invest in markets where the smart kids go, not the cool kids, right? And so the smart kids are going to be investing where the best rates of returns are going to be, and where the overall growth is, right? So yes, maybe not Nashville, but if you think Nashville is a market you'd like to be close to, what Hervé's done is put together what the top markets around Nashville may be, secondary markets, right? Secondary cities that are perhaps within a stone's throw or inside of a day's drive of Nashville that are going to get the economic spillover from Nashville, but are not going to be priced at Nashville price points. Okay. That's the Market Hunter Compass. And you guys can get that by going to DeRosaGroup.com/compass, DeRosaGroup.com/compass. Go and download that for free because we care about you guys. We want to see you guys hit your investing goals. So go now, DeRosaGroup.com/compass and grab a copy of that. And Hervé had said as well, It's the most downloaded. Hundreds and hundreds of people have downloaded this tool and have told us how beneficial it is. That is Hervé's Market Hunter tool, and you can get that by going to Market Tool at DeRosaGroup.com/Market Tool. DeRosaGroup.com/Market Tool, and that's there to just help you score a market. And it could be you could use the Market Hunter Compass to pick a market and validate that you chose the right one using the Market Hunter tool, and it'll help you get to know what factors are there. What is job growth? What is how diversified is that market with regards to economic diversity? These are great things to tell your investors, maybe even to show your investors you've done your homework and those kinds of things, right? Yeah. Hervé, so then that ties me in to the last item here that I want to throw out. Number one, that I always appreciate talking with you, and so do our students. And for those that want to get more inside that brain of yours that comes up with these wacky ideas of, hey, you know what we need? We need a secondary market tool. We need to make a list of all the secondary markets across the United States. Or, well, you know what I'll do? I'll go and put a list of all the brokers that are there that are heavy in apartment building real estate, and I'll put that list together for our students. That is a student only list. We also have it for sale on our website, which you guys could get. But Hervé has assembled a lot of these things because he's really trying to put forth value. And if you guys really want to really glean the value that DeRosa Group has, consider joining our accelerator, right? DeRosaGroup.com/accelerator. It's very affordable. It's a couple $100 a month to be a part of the program at the baseline entry point. And you get to go to my office hours, which are today, 3:00. You could join now, and today at 3:00, be chatting with me and with me and Hervé. With me at 3:00. Hervé's, yours are tonight, I think.
Tonight at 7 p.m. Eastern. That's right.
Yeah. Guys, we have daily access to DeRosa team members, and if you upgrade your membership just a little bit, you can get one-on-one coaching with me, yours truly, one-on-one with Hervé, or one-on-one with the Justin Fraser, the guy that keeps me and Hervé straight. He's our guardrails of our company, keeps us pointed in the right direction and all that.
That's right.
Yeah. So that's Accelerator. And Hervé, last thing to mention here, one more free thing to give away, guys. Hervé, in a couple of weeks, you're doing a workshop because you really got some cool stuff to put out there, right?
Yeah.
You and I are doing it. Or you and I are doing a workshop. What are we going to be talking about?
Oh, this is currently in developmental phase since it is about 2 to almost 3 weeks away. But I'll tell you right now what it's going to be. It's going to be another tale of the tape. It's going to be a tale of the tape. It's going to be a workshop discussing investing in the Sun Belt versus investing in the Midwest.
Oh, Hervé, no, I think we're talking about, because Sun Belt is automatically better than the Midwest. Sun Belt is the best real estate investing region that's ever been invented, because you've got Austin and you got Atlanta, and you're not going to beat those markets in Charlotte. So bye-bye. No reason to even compare to the Midwest, right, Hervé? Why are we even doing this?
I'll tell you right now, Midwest, look out. Look out, Midwest.
Okay.
They've been punching their way to the top of the ticket, Matt. They've been punching their way. They're on their way. They're making a name for themselves. Look out. Yeah. They come from around the corner and they make it real. There's a lot of compelling reasons to take a look at opportunities, to take a look at secondary markets in the Midwest, right? I mean, again, it's kind of like going someplace where other folks have not been. Doing something a little bit different, going to that area where there is not as much competition versus another area, whatnot, trying to be ahead of the game, think ahead of the game. And there are opportunities in these Midwest markets that are going to allow you, if you so choose, to go ahead and be a little bit ahead of the game, right? Punch your way to the top of the ticket, so to speak. So it's going to be a real nice presentation. We're going to lay it out. We're going to show you guys a lot of information, a lot of data dump. We're not knocking one market or another. Matt or I, we're not going to select for you to invest in one market or another. Each markets, they certainly give and provide, right, some real compelling reasons to go ahead and invest. We're going to allow you guys to be the judges, right, on deciding which markets are more attractive to invest. those in the Sun Belt versus those in the Midwest.
And as Hervé knows, I like throwing stink bombs at him as often as I can. So I am aware. And we are invested in the Midwest as DeRosa. We're invested in both these markets, the Sun Belt and in the Midwest. And so we're very knowledgeable on it. And Hervé, I think, is going to be putting together a great conversation for us on really it expands onto how you guys should evaluate markets, but also there is conversation that maybe it'll help you guys generate which markets you really want to focus on for 2025 and beyond. We're also going to be pulling on a few students, a few prospects here that are on the market that want to join us live, that want to talk to Matt and Hervé about things that are going on in their real estate investing business. And hopefully Hervé and I can give them some well-founded, well-thought-out advice about what's going on, whether we think they should go left or go right, whatever that may be. And that's so register for that webinar right now, guys, because there's going to be, like Hervé said, free advice. There's going to be some great direction on Sunbelt or Midwest, and also you'll hear a lot of our mindset and philosophy. And we're going to be doing free giveaways. I think a digital copy of an ebook that I wrote on how to do your first apartment building deal. Maybe some other free giveaways in the works as well. This is not a webinar that's just going to get recorded, you register for, and you watch whenever you feel like it. This is a workshop, guys. This is, you roll your sleeves up, you bring a notepad, and you get there live, because this is not something you can watch the recording on. You have to be there live on the program. This is an interactive back and forth conversation with Matt and Hervé like you've never experienced before. The October workshop, register right now by going to DeRosaGood.com/October workshop. And we'll see you guys there.
Absolutely. And just a reminder, the workshop will not be recorded. And in order for you to get the free tools that we're going to be putting out there, you must register and attend the workshop, not just register for the workshop. So you got to be there in order to get what we're giving out.
Few quick shout outs. Our friend Tara recommends the accelerator. Tara is slaying it as an accelerator student. Tara, you're crushing it. Heart goes out to you. Thank you to you and your awesome husband, Storm. Hope you guys are doing well. Looking forward to seeing you probably at my office hours in a little bit. And thank you for your kind words. And also, people are taking you up on your offers here, Hervé. I got Joe Chen. Thank you so much for hosting this live. Looking forward to checking out this market tool that you guys just shared. So Joe is going to get in there and check it out. Joe, good luck. I hope you join us on the October workshop as well. Hervé, that's it, man. We got to wrap this thing up.
All right,
Hervé and I got business to do. We got a 1 o'clock call. We got to get on. Hervé, I'll wind this up. I'll let you pop off this stream so you can go over there, and I'll close this down. Okay.
All right, sounds good, man. Thanks.
All right, I'll see you there. Hervé, thank you. Always great being with you. Talking a little market shop. Lots of hearts, lots of thumbs ups to Hervé. See you, bud. Guys, I wish that there were things like this available when I first got started in real estate investing. And the majority of what we provide is free because we care, because we believe in this, transforming lives through real estate. We want you to hit your wealth goals through your real estate investing journey. Whether you do that free by watching a lot of our YouTube videos, downloading all these free tools that we're providing. And if you choose to, you don't have to, but if you choose to join DeRosa for a couple $100 a month in some of our education programs, we do want to see you there. We want you to hit your goals, not because we want to make lots of money off of you, but because we care about where you're going. And we know that if you guys subscribe to the DeRosa philosophy of transforming lives through real estate, you will aid us in doing this as well through giving a better life to the tenants that might live in your property, perhaps hiring some staff and providing jobs and providing good economic growth all the way across your board in your businesses. We want to create thriving businesses across the country because of this, because that's what it means for us. So please do join us in the workshop on Thursday, on October 17th, and we will see you guys there. Thank you guys. Every Tuesday, I go live here on all these feeds you guys are watching. So hope I see you guys next week. Take care.